Great. So thanks again for joining us for today's Sifted Talks in partnership with Stripe. The current economic circumstances, as you know, have left many startups grappling with the decision of whether to scale back operations or invest in growth. So our panelists today will give their thoughts and experience on what companies should be prioritizing, how they can troubleshoot problems and get their revenue into a good place. So I'll just introduce my panelists for today. We've got Kamael Ann Sugrim, Head of Investor Partnerships EMEA for Stripe, Geraldine MacCarthy, Chief Revenue Officer for Personio, JC Taunay-Bucalo, Chief Revenue Officer for Travelperk, and Morgane Zerath, Principal at Crane Venture Partners. So thanks very much, everybody, for joining. Just to let everyone in the audience know, we won't have a dedicated 5-minute Q&A at the end of the session, so I'll be taking questions throughout. If you could submit any questions using the Q&A function below, we'll discuss the most popular questions that come up. Great. So I think where I'd like to start this conversation is just to get a bit of the lay of the land. So under the current economic circumstances, how would you all say that companies are reorientating their revenue strategy? And maybe you could give some specific examples of what you're seeing right now.
I think is really exciting is maybe about a year or two ago, a lot of the conversations or questions we got asked is like how to build a great product. And we still get asked those questions in the incubators and accelerators, but now we're seeing a lot of questions around how do I monetize? And that's a very interesting thing for a pre-seed company. To be asking at that stage, you know, how do I monetize? How do I start to collect revenue on my product or my idea? How do I test a pricing model? So I think it's a really top of mind, you know, how do you generate revenue? How do you create a revenue stream, even for companies that are still in the process of finalizing what their MVP would look like? And that's something that's moved forward a lot in the last year. And I think we weren't really seeing that before. So it's pretty exciting, I think.
Geraldine, you're nodding your head. Is there anything that you'd like to add here about revenue strategy?
Yeah, thanks. And a lot of what Morgane and Kamael have said already resonates quite a lot. I think what's interesting, you know, my role is on the revenue side. So I see it probably from both sides in terms of the customers we're talking to, but also how we think about it internally. And I think what's interesting is, you know, thinking about product and that strategy, but I think also thinking about the people that you have on your team and making sure that they understand what's needed in the current environment. I think particularly in the tech environment, what's interesting is many folks haven't been through a downturn before. And so whether that's internally in the business or whether that's with our customers that we're talking to, is really helping to educate them on that journey. And, you know, sometimes when environments are more fiscally prudent, let's say, that's not necessarily a bad thing. That is just part of a normal economic cycle. And helping our teams to understand how to support our customers in the good times and the more challenging times, I think is something that can be very helpful. I think the other piece around it, and I think we'll probably talk about it more later on as well, is sometimes there is positive parts of downturns, and I think particularly with revenue strategy. So moving from an environment of growth at all costs, sometimes there was maybe investments that were made that didn't necessarily give you the payback that's needed. And so as you think about your revenue growth in the current environment, it's a much more considered and thoughtful and actually long-term, much more scalable way of growing a business. And I see a lot of businesses thinking about where they're going to invest their cash to make maximum impact. So whether that is about the market channels that you're using or the markets that you're going into to validate, I think there's a lot of pieces in there to be really thoughtful and systematic on in businesses right now from a revenue growth perspective.
JC, did you want to add anything?
No, honestly, not much more than what has been said before. I think that was fantastic.
Okay. Kamael, I just want to go back to what you said about, you know, speaking with early stage startups and they're coming to you saying, how do we generate revenue? Or, you know, we want to develop new revenue streams, etc. What kind of advice are you giving to those companies at the moment? Like, is investing in new revenue streams a good thing right now? Or is that something that companies shouldn't be thinking about?
Yeah, and I think it's a great question, and the answer often varies on the stage. If you're very early stage, pre-seed, and you're at an MVP, we're encouraging you to think about revenue. And often you're like caught up in the development of the product, and you're like, okay, I've got to fix this, I've got to fix that, and we're encouraging people to kind of go out very early and test receiving payments for their products, and to test, what is the right pricing. And I think it's when you sort of go into sort of later stage companies, what we're saying is, how are you optimizing your kind of revenue collection? Are you looking at fraud? Are you looking at consistency of payments? Have you thought about looking at a subscription model that will, provide maybe a bit more stability to your revenue? Are you looking at, generating or creating a marketplace alongside, what you're selling maybe as a bespoke? Could you spin out a piece of your business into a more stable revenue structure? Maybe creating a B2B out of a B2C business. So like, these are the kind of conversations we're having with customers, is how do you kind of evolve your revenue and business model for a lot more stability, and kind of like, what do you put in place to kind of take off easily? And I think another thing that we're having a conversation about, which I find very delightful about Europe and just exciting, is that people are really looking at new markets and how to get into new markets a lot faster than I think they have in the past. I'm based in Amsterdam, so if you are a company in the Netherlands, it's a great market. It is a small market, and maybe you would have waited 3 to 4 years before you looked at the German market, but now you're looking at it now and trying to understand how you're going to get into that market. And we're definitely helping like a lot of startups earlier on in their journey move into new markets, and I think that's pretty exciting.
Yeah, I think it's quite interesting because there seems to be like two things that are often perhaps pitted against each other, which is on one side being lean and operationally efficient and working towards profitability, and then the contrast is the growth side. And often I think people think that one has to happen at the expense of the other. But how would you think about that in terms of, having a clear path to profitability, but then also making sure that you're kind of growing at the same time?
Well, I think the cost of actually, software development and going online with your business has dropped dramatically. So we did a recent study and found out that, it went from somewhere like 4 million and 10 years ago, or in the last, economic recession, to around 4,000 now. So I think just the actual cost of like going into a new business stream or exploring a new revenue stream is a lot lower, and therefore the decision to focus on revenue is a lot easier than it was in the past, because in the past you kind of had a huge cost structure to actually look at a new revenue stream or to look at adding an additional functionality to your business. And now that's a lot lower, and I think it gives founders a really nice space to really be imaginative in a time where you might be thinking in a contracting way. Now you can think of it in an expansive way, just because the costs have come down so much.
Morgane, I mean, in terms of the companies that you're working with, I know you said it's quite like early stage, but when founders come to you and say, what should we be doing? Should we be looking at profitability because that's what investors seem to want us to do, but then also we feel like we've got to kind of go to market, expand. How are you kind of advising them to weigh up these priorities?
It's the 1 million question. Again, at our stage, companies are not profitable. Can you hear me well, by the way? Is my connection getting better? Okay. So at our stage, companies are not profitable, and this is not a red flag at all. We don't expect them to be profitable. At Crane, we only invest in enterprise B2B SaaS, and we need to see very fast growth. Usually it comes with a lot of cash burned, which is fine. But the key questions that we'll be asking our founders is, how do they plan to become profitable? Because even though we don't invest in profitable businesses, they're going to have to raise money in the future, and they're going to have to be profitable. I think that what they need to understand is the growth needs to be sustainable. So they can choose one over the other. So let's say if they want to prioritize profitability, it's going to be at the expense of growth for sure. And they'll be eaten alive by competition, especially in the space that we are covering. There's always a window of opportunity, a market timing element. If you don't capture your market share, someone will capture it for you. So you cannot choose, but you need to build your business with a few things in mind. And us as seed investors, we are always looking at a few things, and maybe I can mention a few examples for founders to bear in mind, because they'll always get the same questions. Usually when we invest, there is literally no metrics and no profitability metrics, but we need to be quite creative and try and find out how it's going to look like when they scale. So there are a few things that we always try and understand. First of all, how much does it cost you to acquire a new customer? For example, we're working with a company in the UK, hardcore enterprise play in computer vision. They have extremely long sales cycles. For us, it's fine because they have, so extremely long sales cycles, which means very high customer acquisition cost, which is fine for us because each contract that they're signing is a 7-figure deal. So if you have a very high CAC, it needs to go with high ACV. If you have high CAC but low contract values, then you're going to be in a tough spot in terms of profitability. Another thing that we're always looking for is understanding the total value that a customer can bring you and can generate over like the lifetime of their relationship with you. Super important for us to understand the land and expand. It's not all about landing big deals. It's about expanding those with additional modules, additional seats. So it's something that we need to understand, and something at Tassian in my previous company in cyber, something that we're always thinking of, because it helps you with your CAC as well, and your growth. And of course, as a VC investor, especially in seed, because the burn rates are super high, we need to understand the runway big time, how long they have cash for, and we need to make sure that they're going to be able to raise again. So if they burn a lot each month, but they have to raise again in a few months, but they will still be pre-revenue, we anticipate a potential difficult situation. So we work with our portfolio sometimes on seed extensions, but they need to be bridges and not peers, otherwise it's a recipe for disaster. So these are the few things, and maybe the last thing that we look at a lot is gross margin. So if you grow fast, we need to make sure that it's not at the expense of your gross margin, and there are some models that we'll be a bit more cautious about. We've been looking at companies in the past where to be able to grow, you need to have physical presence in different countries. And this goes back to your point, Kamael. How sustainable is it to grow geographically if you need to have physical presence? It's much more interesting for us when you don't have to have a big team in each geo, because it eats on your gross margin. So all of those things are affecting your profitability. And so we need to try and be creative and try and understand what the path to scale will look like when they grow.
Thanks very much for that, Morgane. I'm just wondering from like the later stage perspective, so Personio and Travelperk are obviously mature companies. How do you kind of, face this conundrum, if you can call it that, of being lean and operationally efficient, profitable, but then also continuing to grow during the downturn?
It's a great question. So I think there are two sides to it. I think the first side, and I might be slightly unpopular with that, is the huge downturn is for VC-funded company, which is a tiny, 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 tiny part of the economy. I cannot emphasize that enough. The rest of the economy is actually doing relatively well. There were times, and some of us around this table were there, of real recession of high unemployment. That's not what's happening today. And I think this is, I cannot emphasize that enough, because that's the story of Travelperk. Like, let's get out of the VC bubble. No disrespect, Morgane. Let's get out of the VC bubble. This is really important. The retail market has never done so much. The energy market has done really well. The real estate market is doing really well, except commercial real estate. That there is actually a lot of opportunity in the real world. So I think the first thing I will look at is what happened often with startup. Being honestly early stage, mid stage, and sometimes even late stage startup is you start by selling to other startup because they are early adopter and they're gonna accept your, slightly inadequate product a bit more than traditional company do. But at some point you need to cross the chasm. You need to go to more traditional company. And frankly, in a moment where VC-backed companies are getting less money, so they are less likely to buy your software, or definitely less likely to lend and expand, that might be the good moment to go to slightly more traditional company. So I think that's one part. The second part, specifically more for late-stage company, is to not look at aggregate. looking at, and that's very different from early stage, looking at CAC as an aggregate in a late stage company is totally pointless, because the reality is your CAC is going to be very different by segment, by country, by persona, by size of company. So it is absolutely necessary to go one level down and say, okay, my CAC in the US might be 30 months, but my CAC in Europe is 12 months. So my months to recover CAC. So I can double down in Europe and I might kind of slow down a little bit in the US. My average might be 15, but it's an irrelevant piece of information if I don't go one level down. So really in capital allocation, in late stage, it's really important to segment. Being geography, being size, depends on company.
Maybe to take a slightly contrarian point to JC's viewpoint on that, at least some of the stuff that we're seeing out in the market. So we recently did a study across Europe with executives at the C-level and HR decision makers, and we studied 6,500 people, and 69% of them said that they wanted to be more operationally efficient. So I do think there is that desire to be more operationally efficient, maybe less at the extreme level as we're seeing at VCs, but I still think in the broader economic environment in Europe, customers are looking and businesses are looking to do that. And what was interesting though, of that 69%, 48% of them said that they didn't know or they didn't have a strategy for how to become more efficient. So I think that's a really interesting strategy, that there's the desire within the market, but there's not necessarily the ability to know how to do it. And these are, scale companies. These are companies of all sizes, VCs or non-VCs. And I think that's particularly a space that tech companies can play into to support businesses in their operational efficiency by allowing their businesses, and particularly their people and their processes, to be much more efficient and to grow at scale. Maybe just to talk specifically about some of the stuff that we have done in Personio to really improve that efficiency. At the beginning of this year, we implemented something called Winning Wednesdays. Winning Wednesdays is a full day where everybody is meeting free, and it's really to focus and allow people to do their core work, and that we're all doing it on one day together. And we really see a productivity impact from that. That's something that hasn't required any investment, just a little bit of organization in our calendars to get it done. And it's been not only just given us a great productivity impact, but great feedback from our teams as well. And then something else that we have implemented, particularly as organizations scale, and sometimes you don't see all of the inefficiencies in your business. We have over 1,700 employees, so I can't see, nor can Hannah, our CEO, see all the inefficiencies in the business. And so we've created a process which we've called Momentum Mojo internally, but it's really about helping people to identify either systems or processes or old ways of working that maybe worked for us 3 or 4 years ago, but are no longer serving us and holding us back as a company. And so where we can see those pieces are blocked or blocking people to do their best work, that we can find ways to help remove some of those processes. So I think there is definitely a need in the wider environment within our customer base and across all businesses in Europe to become more efficient. And I think there's, quick wins that businesses can implement. But I also think there's an opportunity for a lot of the tech environment to support those companies that I just spoke about there, to help them grow in their efficiencies and to allow them to really realize the value that they want to create over the next couple of years.
Yeah, maybe on that point about becoming more kind of lean and operationally efficient, maybe we can open that up to the panel. Are there any other tips that you could give companies about how to identify maybe what is not so efficient and how to kind of plug those gaps?
Maybe I can jump in a little bit here. I think one of the, kind of core pieces of advice we give, and this is probably like not the best analogy but visually, but hopefully it works, is like, how do you plug the holes in your cheese? Sort of like and when it comes to your revenue, like if you've got sort of like gaps or things that are happening, I apologize, it's not the best visual as I said, but how do you deal with sort of like revenue leakage? And that's a part of your business. So for example, at least with Stripe, we see a lot of companies not have like a good way of detecting if a customer is fraudulent or not fraudulent, and like falsely tagging customers and just elongating and creating a poor relationship with their customer. And so we have we've helped a lot with sort of saying like, this is kind of important, and that's like a hole in your cheese that you need to plug, and it goes a long way in terms of generating customer value. So I think like when you look at your revenue in this environment, are there things that are, need to be tidied up in terms of how you're managing invoicing, how you're managing your billing with your existing customers? Like, are there ways in which that you need, things that you need to look at that maybe you haven't really paid attention to in a growth market because you've had high volume that can cover some of these inefficiencies? And we're often, encouraging our customers to go back and kind of look at these components of how they do business and plug those holes so they're really create a very like strong and like robust revenue model for themselves. And again, I'm sorry about the analogy. We're gonna have to work on a better one.
I like this analogy. I think it's fun. Morgane, do you have anything to add here about how you're kind of advising early stage companies?
Yes, so I guess it's slightly different for early stage companies, like for them, because we're in the building phase. A lot is about building your teams, building your systems, building your processes. So very early on, there are not so many holes in the cheese because like everything is in the building phase. I would say that the thing that we always focus on with our teams when it comes to efficiency is reviewing the hiring plan. And especially in downturns, if you had planned to hire super aggressively, it's probably worth reviewing and revisiting your plan and understand how much you can grow if you delay this particular hiring, maybe front load this other one, etc. So I would say that efficiency for us is all about having a lean team. But again, because we focus on very early stages, it's all in the building phase. You need to be lean to iterate super fast and to be efficient. And maybe a key example of that is we're working with a team in France called Covery, and the founders are still leading the sales motion. This is what we call founder-led sales. To us, it's always what we advise because, of course, they have to understand how to sell the product, but also it helps them iterate super fast. And thanks to this, they've been able to identify very granular use cases. So just going back to my point, to us, like a lot comes from the team and also leveraging the workforce that you have in seat. It's not uncommon as well to see some roles being tweaked in a downturn. And actually it happened to me when I was at Tessia, and at some point during COVID, I jumped back into my sales shoes. It meant I still had my team to manage, and I also was selling myself deals and closing deals myself. Super difficult to implement, maybe not always the best idea, but a very good opportunity as well to leverage your team and to make sure that everyone has skin in the game and to keep like this team as lean as possible and as iterative as possible. So we see a lot around the teams, as you can imagine.
Yeah, I find that interesting because some companies that I've spoken to recently say that it can sometimes be difficult to prevent yourself from overhiring. And maybe there's a sense that you need to have more of like a long-term view, right? Because in this kind of environment, I guess everything is changing every couple of months. If you hire that person, maybe that role then becomes redundant and then you have to lay them off, and then, So I just wondered if there's any kind of tips that you have around that to really kind of analyze which hires you actually need and prevent yourselves from actually getting too many team members on board and then having to let them go.
And again, maybe bringing my experience from like a very early stage person, what the conversation. So first of all, it's a trap that a lot of companies fall into. You raise money. So again, I'm talking about the VC world. You raise money, you have a lot of money to deploy, and you're tempted to overhire. It happens to a lot of companies. And for us, the key things that we're always trying to understand with our founders is where are the bottlenecks? Like where are the bottlenecks / where are you not needed anymore? Like, can someone else do this job for you? Like, if it's only you who can do this piece, you should keep doing it. But if you can be easily replaced, that's a good sign that someone else can do it for you. And also, where are your capacities being augmented? So where do you fall short? And we always, well, it's a super fine line, but we always advise them to keep lean, but it's to a certain extent, right? Because they have to build their teams. But overhiring is one of the key mistakes that I've experienced as well myself as a sales leader. You want to grow fast. And so you think, okay, the more bums in seats mean more revenue. It's completely wrong. And I made this mistake myself. So it's all about understanding the bottlenecks and where you can be augmented.
on a very practical level, I will be super cautious with two types of hire. One, hire that are actually designed for a project. That's not a real job. You need to implement a new marketing automation system and you decide to hire 3 people. Now you don't need 3 people. You might need 3 people for 3 months, and then you need 25% of one person. And then you might end up with people that you actually literally don't need, how talented they can be. That's the point number one. The point number two, which is kind of very similar to point number one, being very careful with structure cost. So especially in late stage company, it tends to balloon and you tend to having to have a lot of people who are supporting other people and actually very few people doing the job. Being everywhere, being in sales, being in marketing, being in engineering, you end up with literally more people supporting than actually coding or selling. So I'll be very, very cautious with these two because we can sometimes lie to ourselves saying, oh, there will be this improvement in productivity. My last advice, a very practical advice that I do with my team, which might or might not make me popular sometimes, when the team wants to buy a new software, for example, and they say, this new software will improve my productivity of my outbound team that has happened recently by 10%. I'm like, great. So I'm going to increase all of your target by 5%. That should be a good deal. And then I signed off. And then you actually see if they really want it. Because logically, if that's the case, they need to be totally comfortable increasing the target by 5%. And I think that's a good stress test again, so that you avoid this ballooning of pseudo productivity tools. And sometimes it's not the fault of the tool. It's just people don't put the energy into implementing it properly and training people. So it results into no increase of productivity. When they are accepting an increase of target, generally that means they really want it.
Yes, I remember this conversation during COVID when everybody switched to remote and then everyone was like, I'm drowning in tools and I've got notifications coming from 10 different platforms and I don't know what to do. So I think that's good advice. I just want to speak a little bit more about kind of past recession learnings, because I know that we have a few people on the panel that have actually seen, as you put it, JC, real crises. Geraldine, you also mentioned in our pre-panel call that a lot of recession management is actually educating your team, right, on how to kind of manage through the crisis phase. So maybe you could speak a little bit about what your learnings are from prior recessions and what you're kind of enacting at Personio now.
Yeah, for sure. And I always say I'm a dinosaur in the business because this is my 4th recession. So, but actually, I think one of the things that we were talking to the teams, let's say a little while ago, was not to be afraid of a recession. It's a great learning experience. It usually makes businesses much more efficient and makes much more focused decisions, which is kind of what we're talking about a little bit here today already anyway. And that allows businesses ultimately to scale stronger and better in the long run. And this won't be the last recession that we see. Without being a doomsday person, I can pretty much guarantee we will probably see another recession sometime in this century. And so one of the things, you know, really going back to last year that we were talking about with our teams was not to fear it and really to embrace what is ahead, and that using that as a learning and a growth opportunity in terms of what each individual can do with that. So I think first of all, it's just mindset with it, you know, whether you're annoyed about it or fearful about it, or just kind of going in with, I don't know what's ahead. It doesn't change the reality on the ground. The reality on the ground is that we are in a kind of very volatile macroeconomic climate. And if you can come into that with the right mindset, that's half the battle already. So we did spend some time on that with the teams last year, really just to help them go through that. But I think now, particularly as we're kind of in the middle of some of the fallout that we're seeing, is really helping the teams to understand what are the things that they need to look out for within their team. So particularly, you know, my role is Chief Revenue Officer. So a lot of the time I'm dealing with sales teams or marketing teams, and really to help them understand what are the metrics that they want to look out for as they're looking through their team. So whether that's around, you know, deal cycles that are lengthening and what we can do to support on that, or whether that's around conversion rates changing and how we can support on some of that as well. And rather than just taking it, that's a statement of fact and that there's nothing that we can do, there's actually quite a lot that you can do to do something that's beneficial for your business, but that's also supporting the wider ecosystem as well. And so that's some of the pieces that we're working through within our teams So for example, I know it's talked about quite a lot, but one of the things that you see in sales cycles right now is that much more decision makers are coming in to particularly B2B SaaS purchases. And actually that's a great thing. But rather than saying that that's coming as a surprise at the very end of the process as you're negotiating the deal, let's bring those people that we're seeing coming in at the end of the deal, let's bring them in early in the deal instead, so that you can run a process in a much more controlled and structured way. And so I think there's mindset to bring in, but there's also learnings that you can bring into the teams. And as you go through each cycle of learning, that you bring that learning back into the team to be more proactive and on the front foot about it, rather than sitting back and saying, oh, this is yet one more problem that we need to deal with, because most things are solvable or are there for good reason.
Yeah, I mean, as a leader, is it kind of good practice to just be optimistic? Or is there a sense that you do have to bring some kind of realism? You know, like if you're hiring people, especially kind of maybe graduates or younger people that haven't seen a crisis as severe as this before, is there a sense that you kind of have to give a bit of like tough love to these people? Or how do you manage that as a leader?
Yeah, I mean, I can talk about it a little bit, and I'm sure JC has some thoughts on it too, but I think being optimistic comes across as fake, you know, and I think teams will not appreciate that. They will not, it doesn't resonate if you're just like unnecessarily euphoric about everything. And I think having a level of realism that you bring into the teams, and actually just talk about, you know, where things are at, and using it as an opportunity for growth and learning. And I'm really, you know, I guess I experienced that myself as a grad. I came out of college in 2001, so it was right in the middle of the, you know, the .com burst, and so I experienced it as a grad myself. And so just really talking in real terms that you understand what it means. It doesn't mean that every day is easy. I think there's just challenges in different ways now than there was, for example, in 2020, but using that as an opportunity for professional growth, I think is the right way to do it. I think if you are unnecessarily euphoric or optimistic, it comes across as fake, but potentially also over-promising to your teams about what to expect as well.
Yeah, I mean, JC, you also mentioned in our pre-panel discussion that, you know, Travelperk went through its kind of own crisis 2 or 3 years ago, right, during COVID, with revenue dropping to kind of nil overnight, which must have been quite terrifying at the time. But what would you say were the steps you took, like the concrete steps that you took to kind of help yourself out of that situation? And maybe you could also speak a little bit about how you communicated internally with employees about what you were doing.
Yeah, I mean, what we have was it's a bit particular because generally recession are long and painful, whereas we went from 20 million revenue to 0 in a week, and then we rebuilt that from 0 to 100 million in 2 years. So it's a bit particular because of more crisis management than it is recession, because generally recession is just like this long burn of pain. But there are a couple of things to get out of it. The first one is past the first shock. When things started to be, okay, it's hard, but it's manageable, is finding a way out. I think the biggest thing, and I'm totally agree with Geraldine, is you cannot be and you shouldn't be overly optimistic. Equally, you need to show a way out. You cannot tell the team it's going to be really hard. I don't really know how we get out. I don't really know how we get strong out of it. Like, there need to be excitement about this is the way out. The way out might be very different. And I think that's my point number 2 is if you consider that you are in a very deep crisis, not like a little bump in the road, which I think is, and I think the jury is still out about what's happening right now, about whether it's like, okay, a little bump in the road or a deep crisis. If it's a deep crisis, we're going to need to rethink how we work, how we sell, how we consider unit economics, what we consider to be target market. If it's just a bump in the road, then you adjust, you wait for the second kind of wave, and then you come back. And as I mentioned before, in our case, the biggest change was to change partly the business model of the company and definitely change the target market. Move from targeting consulting and tech company almost exclusively to targeting companies that were way more resistant to any form of economic downturn, or in this case, COVID crisis. But I think that was particular to travel. I think the thing to take out of it is when it's hard, the team will look at you to have a way out. It might be a painful way out. That might not be fun. But there is a path forward, and then it's a call to arms. It's like, are you with me or are you not? And it's okay for people to not want this call, like that's okay. But the people who want to be with you, they know what the reality will look like.
Yeah, I think that's right. I mean, I remember speaking with Naren Sham, who is the founder of Omio, and they also had a similar situation. They're a travel company, and their revenue dropped to nil overnight. And I remember Naren telling me, you know, as a leader, you just have to show up. Like, even though you really do not want to, you do not want to sit on Zoom with hundreds of people and have to explain what's going on. You just have to be so kind of brutally honest and be honest about what you don't know as well, perhaps.
Yeah, absolutely. You need to be honest about what you know, what you don't know. And yeah, I think that was a key point. I mean, especially in the COVID crisis, like there was a lot of unknown just by just the very nature of it. And knowing, I do not know that, but should this happen, this is the decision we will make. And it's exhausting. I think this is something that every leader needs to know, especially when it's the first time, is as a leader going through a crisis and keeping the head above the water of your entire team is absolutely exhausted. So if as a leader, being CEO or being C-level, you feel exhausted right now, that's normal. I don't know if that will make you feel much better, but it's normal.
Yeah, in terms of like speaking about specifics of, you know, you kind of mentioned that you had to be a lot more disciplined in terms of what you're investing in and maybe went a little bit undercover for a bit. What are like the good signs, or maybe speaking specifically about you, like what were the signs that it was a good time to begin reinvesting in growth?
I think that's valid for everybody. I mean, that will be the same for everyone. Is you just look at core metrics. So you look at your core metric, which in our case was pipeline conversion ratio, and then revenue generated. And so the moment where we started the pipeline to go above a certain level, the moment we started to see the conversion go above a certain level, well, okay, that's fine. We're kind of back on track. We know how to rebuild. But again, I cannot emphasize that enough. Like, it was not comparable. So we used the metric to compare, but everything else was not comparable. It was literally different target market, different go-to-market, different sales cycle, even different revenue structure. So it doesn't need to be the same, but there need to be a tipping point where you say, okay, now it's looking good. Because my only little advice on this part is, this is why we went from 20 to 0 and 0 to 100 in 3 years. We will have never gone from 20 to 100 that fast without COVID, as paradoxically as it sounds, because during crisis, everybody's terrified. So everybody cut down. If you can be the one that accelerate at the right time before the other one, then you take over the market. If you do it too early, you die along the way. That's not a great output. But if you wait too late, you have missed an opportunity to take over the market when everybody is terrified to reinvest. And we reaccelerated probably a year and a half before the rest of the travel market. And that's why we grew much faster. So there is a virtue about having this courage to know when is this moment, and accelerating probably a little bit before the common knowledge of everybody else.
Does anyone else have anything to add on signs that growth is a good idea?
Yeah, just to build on JC's point a little bit. So actually all the studies show that companies that continue to invest during a downturn actually come out much stronger. I think Travelperk is an amazing example of it, and congrats on all you've achieved, because it's a really amazing story. I think what's interesting when you think within current businesses is to assess what you already have, and what can you do with what you have, and then from there, how can you grow? So for example, for most businesses, actually people is one of their biggest costs. So how can you really focus on ensuring that you can enable and support and train your teams at a time maybe when things are a bit tougher? Because if you can do that at the right time, then when the market is ready, depending on your vertical, depending on your specific product, actually your people are ready to accelerate. Your metrics are sometimes a slightly lagging indicator because they're going to tell you how things are moving over time. It's almost like looking in the mirror to understand what's happened last month or last quarter, but the people can actually drive that forward at a faster pace. So I think that's really something to consider, particularly at the moment, around how to make sure that you can capture that as the market goes ahead before you even have the metrics to do it.
And I also think it's an interesting time for like skill training and development, as awkward as that might seem, because maybe about 2 years ago, you'd have an idea and you go to your manager and they'd be like, yeah, great, go for it. Try out this new market, see if you can put that product in place, take that idea further. And now I think a lot of managers are asking, what's the return on investment? What's the analysis? Do you understand the cost structure? And for younger employees that have never really been through a dip, in their career, they're starting to pick up a whole new set of skills around analysis of like where they're headed and the choices that they're making. And it's a really, to me, an exciting time to develop the rigor of analysis that you might not actually take the time to do when you're in a bull market and you have a lot of cash and a lot of ideas and a lot of runway to play around with those ideas. Now I think we're seeing a lot of people for the first time in their early careers like really dig into like an Excel spreadsheet, know what an ROI analysis is, understand, a cost structure, think about like a 2-year plan, a 1-year plan, looking at success metrics, all of these things, which seem very obvious when you study business, are often not implemented when you're actually in day-to-day. And we're seeing people kind of go back to that and really dig into like building and boosting their skills.
Maybe one last comment from me, super short, about the signs to reinvest in growth, and also echoing what everyone said. To me, it's all about the pull from the market, and so we always encourage our founders to stay so close to their metrics, because then as soon as you see that the pull is getting there again, you can reinvest, and that's a good sign. So that's really echoing what JC said earlier.
Great, thanks very much. Just got a question from James Gardner. We've talked about productivity gains a lot, but this conversation about Travelperk's recovery sounds like it was less about productivity, but something else. Is it fair to say that productivity might give you small incremental gains, but step change will come from achieving a tipping point in your proposition?
A tough one, because you need a bit of both, and you need a bit of both at different time. I think our story was quite particular because it was such a deep existential crisis when literally people can't use your software. They don't have the right to use your software, which is a bizarre situation. I think my key message on this one is, especially in scale up, and I think that is very different. I've done every stage from literally being like 1 people to now 1,300. So when you're in a startup, actually pivoting, changing your value proposition come quite naturally. When you become a scale up, you have a little bit this curse of having been successful. You have been successful, so it's a bit easier to kind of sit on your laurels, and it's a little bit harder to say, you know what, maybe my value proposition is not how it should be. Maybe my go-to-market is not as good as I think. And I think that's what I meant by kind of using the crisis to rethink that, because when everything goes well, you're not going to do it. Independently from that, when things get a bit tougher, you need to look at incremental productivity. This one, there is no debate about it. I think my only message on this one is when things get hard, maybe go a little bit deeper than just looking about, do I have the right people and can I improve my outbound process? It's like, okay, maybe I should look deeper. Maybe this entire segment of the market is just not the right one for us. And we were built on that, but that's not the future. So I feel personally that crises are a really good moment to challenge things that are very hard to challenge when everything goes well.
Cool, thank you, JC. I just want to use the last kind of 10-15 minutes or so to maybe speak about customers. Morgane, I know you mentioned that you've been speaking a lot with your portfolio companies about retention strategies. Maybe you'd like to expand a little bit on that?
Yes, I think it's one of the key topics at the moment that we're discussing with our companies, because obviously at the moment lots of budget constraints. Buyers are super conscious, cost conscious, and they seek to reduce their spending, or at least they seek to consolidate things. And again, this is what we see in our space. So we've, like, it's easy for us to spot patterns from customers, and we've been working with our companies to try and help them gain new customers, but also retaining their existing customers. I think these budget constraints have quite a few ramifications. So what we're seeing again in our portfolio is that if you focus on areas that offer immediate cost savings, you have a better chance of gaining and retaining your customers. I'm actually thinking of one of our portfolio companies called Axiom in the UK. They're basically, once you start talking to them, you understand that you can ingest more data at a price of like much less data. So if it's helping you scaling, it's helping you save money, it's a good thing. And so this is how they've been building their success. What we see as well a lot with our companies and the way we help them retain their customers is through building with them ROI calculators. So it can sound a bit tactical, but it's actually not. And actually, I've seen it firsthand at Tessian as well myself. When I joined Tessian back in 2017, we're purely selling on, oh, we prevent X breaches per year, and buyers were buying based on this. And as we went through the crisis and like the cycles, etc., we understood that we couldn't win deals anymore based on this, and it was more about how much time it's saving your team, how much money it's saving you. So we had to build something a bit deeper than just, oh, we prevent X breaches. So this is something that we work a lot with our customers on. And also in terms of renewal churn rates, definitely something that they're seeing at the moment. Of course, like clients, customers, they're more hesitant to renew. So your churn may go up in those times, but we actually think it's a good time for you to have like best-in-class renewal rates. And you can actually do this, again, like trying to be quite tactical as well. I think there are a few things that our companies have been doing. So first of all, playing with the whole environment, because everyone is trying to consolidate at the moment. If you're not helping them achieve that, you're probably being removed from the stack. So finding the right angle to try and find your spot in that whole consolidation play is a good thing. And also very, very tactical things, but just onboarding your customers in your journey. So again, I think it's easier to do when you're an earlier stage company, but simple things as setting up a customer advisory board that can help you shape your own map. They can feel part of the journey with you, having them co-write case studies with you, having them present at events with you. Very tactical, quite easy to implement. And that's helping you a lot in terms of like engaging your customers in a downturn. And I think you shouldn't do it only in a downturn. You should do it all the time, because that's very super important. And we always say that your customers are your best salespeople, basically.
Yeah, I can imagine though that speaking with customers right now is maybe different to when things are good, right? Maybe all of you perhaps could give some tips then on how do you actually kind of coach your teams perhaps to interact with customers during this time, especially when it involves possibly delivering undesirable news?
Yeah, I can maybe take it, and it's actually building on some of the points I think Morgane has already talked about. So I think first and foremost, when you go back, not even that long ago, but back to 2020, JC mentioned it a minute ago as well, where everybody needed a tool for something. And there was very little business cases going into things to really understand, okay, so what type of impact are we going to see from it? So I do think Morgane mentioned like ROI analysis, really supporting customers to understand why they should make a decision versus not. And I think that's really top of mind within businesses right now. They really want to understand, as much as we're talking about right here, when you invest, what is the type of payback that you're going to get? And that's what customers are really thinking about. As much as everybody on this webinar is thinking about it, all of our customers are thinking about that too. I mentioned that 69% earlier. So I think helping customers to make that and understand what the impact is going to be, I think is really helpful. And I think Morgane, she also mentioned consolidation, and JC was talking about what type of payback you're going to get. Is it a 10% or 5% impact on some of that? But I think, really helping companies to understand, okay, what is within your tech stack right now? What type of value you're getting from each of those pieces? Do you need this right now? And if you don't, that's fine. Or how does it fit in within that, consolidation? It's something that's already within your platform. Can you take something that exists already in there that has, probably less cost of the business, but potentially also a lot more value into businesses as well, where they can actually get everything in one place? Particularly, I would say SMEs who, don't have very big IT or implementation teams that they have that capability to implement. But I think the important thing, particularly for customer-facing teams, is to have that conversation early on and to be really honest. I think, as much as you might want to make a sale today or tomorrow to bring that revenue into your business, I think it's much more important to have honest conversations with businesses. And if it's something that's not going to truly add value to their business, to say that to them upfront, because, as much as we talk about companies, it's people in all of those companies, and those people will remember that level of honesty that you have had when you're dealing with them. So I think I'm echoing maybe a lot of what's already been said, but maybe just to add a little bit more details onto it.
Yeah, and I think from our perspective, we've been working really closely with customers, thinking about like how they operate more efficiently. So, for example, we're working with a company called Penny Lane around how they, recover failed payments, which is a really important part of your revenue collection process. And that's just a shift in thinking about like, how do you protect and preserve your revenue? How do you understand about where you have leakages? Also, how do you save hours on, invoicing and collecting payments and things like that, that are sometimes not the sexier side of revenue, but the most important sides of revenue. How do you deal with bank transfers so you're not losing a lot of money or paying high excess fees? We're having a lot of conversations around, what are the things that you can do and implement in terms of making sure that you're really getting the most revenue out of the existing customers you have in an efficient way. And then how do you, when you acquire new customers, make sure that they have like a very seamless process in onboarding in a very like sensitive time for them when there's a economic downturn.
Yeah, but I totally agree with Joanna. And I think the key point now is the buyers are pragmatic. Like, we are no longer in a time where you do a good pitch and you sell it. Like, and that there is there are multiple stakeholders, which is also a good way for company generally to not be sold to, but actually to buy something they really need. So this is why, for me, it goes back to like, what's your value proposition? Who do you do it for? And does that actually add value? Can you look yourself in the mirror and say, actually, if I sell to this company, they're going to be really sincerely better off. And I think that's one of the key parts, which link with that, by the way, a very good tactic personally I have seen is going back to old lost opportunities. Because actually a lot of your old lost opportunities where sometimes they might have gone with competitors that are really good at pitching, but actually not very good at delivering. And if you as a company are sincerely very good at delivering, you might have an opportunity to go to this old loss opportunity, because again, we're in a time of much more pragmatic buyer. And again, it might sound weird, but I actually quite like it, because I think now the best solution wins, not the one that's the most well marketing, not necessarily the one that's the most well pitched. You actually need to go down to the nitty gritty detail about, is this solution really good? Do you really add value to this customer? And I think that forces company to really look themselves in the mirror, and sometimes it's tough.
Great. Well, I don't know if anybody has anything else that they'd like to add that we haven't already discussed, or if the audience wants to send any last minute questions. Cool. Okay, well, thank you very much to everyone who joined, and thank you to our partners Stripe for their support, and also to our fabulous panelists for their insights today. See you all next for the next Sifted Talks, and you can follow the link that is being dropped into the chat box now.